Good afternoon, everyone. My name is Alex Sherman, and today we're going to be talking about something that we constantly hear about, but we don't fully understand: the stock market. Whether it's the rise and the fall of the Dow Jones or our parents mentioning their retirement savings, the stock market seems to affect everything. But what exactly is it? Why is it so important, and how did it come to be? To answer that, we're going over 3 points. First, we'll look at what the stock market is and why it is so important, so you can understand the basics of buying and selling shares with companies. Then, we'll look at the history of the stock market and how it came to be and how it has shaped global economies today. Finally, we'll look at the impact of the economy and how it has influenced businesses and our everyday lives. The stock market is like a giant farmer's market, but instead of fruits and veggies, people buy and sell shares of companies. When you own a share of a company, you own a tiny piece of that company. So these stocks then can be traded on exchanges. Think of it like a giant supermarket where buyers and sellers come together to exchange items, or in this case, shares. Then these prices of stocks fluctuate based on supply and demand. For example, if everyone wants to buy a stock in Amazon, then the price is going to increase. But if everyone wants to sell their stock in Amazon, the price is going to decrease. So how does someone make money off of the stock market? Well, there's 2 ways. There's dividends, which is when a company makes profit and they share it with their stockholders. Then there's capital gain. According to NASDAQ, capital gain is when you sell stock for more than what you bought it for. For example, if you bought a $100 pair of sneakers, and over time they accumulate and they're now worth over $200. But just like how, unfortunately, sneaker prices drop just like stock prices, sometimes the stock market can also lose you money. So just like how you regret buying that $200 pair of sneakers because they ended up not being cool anymore, people lose money in the stock market because their shares lose value. Now we're going to take a trip back in time to where it all began, back in 1602 in Amsterdam, where a company called the Dutch East India Company became the first publicly traded company. According to Economics Help, this was the first publicly traded open company, and people would buy shares of this company in hopes that as the company grew, they would make profit. Then, in 1792, there was a bunch of merchants who met in New York City underneath a buttonwood tree on Wall Street. There, they agreed to trade stocks and bonds, thus eventually creating the New York Stock Exchange. Then, in 1896, the Dow Jones Industrial Average was invented. This was made to track the performances of key companies in the stock market. Today, the Dow Jones and the S&P 500 are vital indicators of the stock market health. Then, though the stock market has been successful, it hasn't been smooth sailing. In 1929, possibly the biggest stock market crash yet happened, which led to the Great Depression. People lost their savings overnight. And then in 2008, another financial crisis happened where the housing bubble burst, causing global financial chaos. And then we have the most recent one in 2020 with COVID-19 due to mounting worries about COVID. So, you know what they say, what comes up must come down, and sometimes it comes down hard. And then there's the impact of the stock market. Some people may ask, I don't invest in the stock market, so how would it impact me? Well, there are multiple different ways it can impact you. For example, your parents probably have some sort of retirement plan, like the 401k. And majority of 401ks plans are invested into the stock market. So if the stock market is doing successful, then your parents probably likely retire comfortably. But if the stock market crashes, then your parents may have to work for a few more years. Sorry, Mom and Dad. Then, the, then there, then there's, then, but it doesn't just. It also impacts also impacts the business aspect too. For example, if a company if their stock prices are rising, then they have capital gain and can expand more, hire new people, and invest in new projects, thus creating jobs and stimulating the economy. Otherwise, but it can also, if their stock prices are down, then it can also lead to budget cuts. So then people have to get laid off, and then companies do go under. Think of it like a roller coaster. Sometimes it goes up and sometimes it comes down. When you're going up, it's really exciting, and when you're plummeting down, you have to hold on tight. It doesn't just affect businesses, but it also affects the government. According to SoFi, government changes policies on the stock market because of the performance of it. For example, when COVID-19 hit, global governments all over the world tried to combat this stock market crash by lowering interest rates and pumping money into the economy. Though it doesn't just affect business, but it also affects the confidence of consumers. When the economy is doing great, people tend to spend more money and likely boost the economy's activity. But if the economy is doing shaky, then people tend to not spend as much money, and that slows down economic growth. So, as we wrap up here, and we realize that knowledge is the best stock in our portfolio, we recap on 3 main points. First, we looked at what the stock market is and why it is so important. We learned what buying and selling shares of companies are. And then we looked into the history of the stock market and how it came to be from its humble beginnings in 1602 in Amsterdam to the world's largest stock exchange happening under a tree on Wall Street. Then, finally, we look at the impact of the stock market and how it has had an impact both on the government, businesses, and consumers. So, I hope that you guys have learned how the stock market functions and why it is so important that we learn more about it.